Welcome to Investing Insights. I'm your host, Margaret Giles, filling in for Ivana Hampton. Over the last 10 years, the average dollar invested in U.S. mutual funds and ETFs earned 1.2% less per year than what those funds returned during the same period. That's the top-line finding in this year's Mind the Gap study, which aims to address the question of where investors succeeded in capturing most of their funds' returns and where they fell short. Jeff Ptak, the lead researcher on this study, is here to break down the takeaways from the report and what investors can do if they want to avoid leaving money on the table. Jeff is Managing Director of Research and Investments for Morningstar Research Services. All right, Jeff, thanks for being here.
Oh, gosh, my pleasure. Thanks for having me.
All right, before we get into the actual findings of this study, I want to make sure we know how you got there. So can you explain how you measure the difference between investor returns and total returns for the Mind the Gap study?
Absolutely, yeah. So maybe we'll start with total returns just because I think it's going to be more familiar to a lot of your viewers and listeners. Total returns are the familiar return that you would find on Morningstar.com and in the fund's filings. You know, it's kind of the language of fund performance, so to speak. And what that assumes is an initial lump sum purchase. So you take your money, you plop it down on day one, you hold it to the end. That's a total return. An investor return, which is proprietary to us, it's something that we came up. It's akin to an internal rate of return. And the key difference between it and a total return is it does not assume you're plopping down that lump sum at the beginning. It's actually taking into account the timing and magnitude of cash flows that come and go to and from an investment over time. And so that way it helps us to approximate the return of the average dollar that's been invested in the fund. And that's a key difference. It yields some insights into what the experience in dollar terms has been for investors as opposed to the total return, which makes an assumption that you're going to plop down that money on day one and hold it to the end, which we know is not reality for a lot of us.
Absolutely. And what's the time frame you're looking at for the study?
We're looking at a 10-year time period. So the most recent study focused on the 10 years ended December 31st, 2024.
Okay. So how does the latest research compare to previous years? Is the quote unquote gap going away or is it here to stay?
The gap, it will not go away. It persists. Yeah. So we found that the gap between investors' aggregate investor return and the total return of the funds that they held was 1.2% per year, which is, it doesn't sound like a lot, but that's a pretty sizable number when you consider the fact that it's equivalent to around 15% of the aggregate total return that all of those funds earned over time. And so it's something that we want to continue paying attention to. It's one of the reasons why we've continued to conduct the study through all of these years.
Right. So this difference in investor returns and total returns isn't just coming from investors who are trying and failing to time the market. There might be some other factors at play. Can you talk about what some of those might be?
For sure. So I think that, the somewhat caricaturized view is of, dumb retail money, people that, are chasing sort of the hot fund of the day, and then they're fleeing, maybe panicking at the first sign of trouble. And I would say that there is some of that. We do see some of those extremes, but I would say that it tends to be a bit more nuanced than that. And I would say that, one of the things that can be just as important to one's success or failure is setting and circumstance. So, one of the things that you can observe, albeit obliquely, in looking at the findings of the study is that some types of investments that are more common to more controlled environments, like a retirement plan, allocation funds, target date funds are probably the quintessential example of that. You see smaller gaps with those. And then the opposite would be something like a sector fund, which is not commonly found in a retirement plan because it is so narrow, because it is so prone to misuse, because they're streaky, and those tend to have bigger gaps. And so again, that's really more a function of circumstance and setting. The setting in this case would be a retirement plan, which is a more controlled environment where maybe investors are less prone to trade and get themselves into trouble that can lead to gaps.
Right. That makes a lot of sense. So it feels like a structural
That's right.
Element at play here.
You got it.
Okay. So I want to talk about where investors are succeeding in capturing most of their funds' returns and maybe where they're falling short, maybe at the asset class level to start and the Morningstar category level. Are there certain categories that stand out for you?
For sure. Yeah. And you're right to ask about this because there's a number of different dimensions that we evaluate funds according to as part of the study. And so one of the primary ones is in our parlance category group. You can think of that as asset class. There's maybe 8 or so of those that we look at, familiar ones like US equity, less familiar ones like allocation, which is our term for multi-asset funds, the most popular version of which would be target date funds. I mention that because that's where we saw the narrowest gap. So what you found is that the average dollar invested in allocation funds over this 10-year period earned about as much as the funds did overall. In other words, investors did a really good job of capturing their fund's total returns. That's what we want to see. Now, what bookends the study? What's on sort of the opposite end of the spectrum? I mentioned it before, sector equity funds. These are narrower, streakier types of strategies. They can prove to be a little bit too hot to handle. We've also talked about circumstantially, they might not be as common in the context of a retirement plan. And so you could find investors are just trading them in a more discretionary ad hoc way, buying high and selling low. That's where we saw the widest gaps. I think that the gap with sector funds was something on the order of 1.5%, which exceeded the baseline for the study as a whole. So that's been sort of a chronic finding of the study, is that the narrower the vehicle is, the more trouble investors tend to have in capturing the total returns.
Right. Not necessarily staying invested, maybe getting a little nervous when things are rocky. So you cut things in a couple different ways in the study. Next, I want to take a look at investment types. So exchange traded funds and mutual funds. We've seen that ETFs have gotten more and more popular over the years. Is there a difference in that return gap between the two investment types?
Yes. So we do see a slightly wider gap for ETFs than we do traditional open-end funds. It's not dramatic, but it's notable. I think the areas where ETF investors got into a bit more trouble, it was places like taxable bonds and then international equity. That's where that gap blew out a little bit more. Actually, you saw in US equity, ETFs actually had a slightly narrower gap than did traditional open-end funds. So there's some puts and takes, but overall, when you look at the top line number, ETF investors captured a bit less of their total returns than did investors in traditional open-end funds.
And does that partially come back to where those funds are held potentially, where you've got retirement accounts versus maybe just taxable?
That's very astute, because one of the things that you would observe about open-end funds is those are fixtures of retirement plans, which I mentioned before, we think are having a salutary effect on investors' ability to capture their funds' total returns. What don't you find? You don't find ETFs in that context. And so that could explain why ETFs, because they're being used out in the wilderness, so to speak, outside of the context of a retirement plan, they may be a bit more prone to misuse for that reason, whereas open-end funds, maybe investors are capturing more of those funds' total returns because they're doing so within the more controlled setting of a retirement plan.
Right. So Morningstar Research has found that by and large, active funds have kind of struggled to beat their benchmarks across the board, but there are certain categories that are better suited for active management. Do you see a difference in the investor return gap when it comes to the management style, active versus passive funds?
Yeah, good question. So we saw a slight difference, but it wasn't dramatic. And so I think it would probably be a bit reductive to say that, with active, for instance, you're less likely to capture your fund's total returns than you would be with a passive alternative. They were too similar, I would say, to conclude that. I think that, one of the takeaways for me in conducting this study is that, investors can do pretty dumb things, or let's say ill-advised things with low-cost, widely diversified index funds, and they could do very advisable things with active funds. It's more a function of how it is they choose to, deploy their capital, and to a certain extent, the setting in which they do so.
Right. Which gets me to my next question here. So you found that the more investors traded, the less they made, the worse off they were. Can you talk a little bit more about that?
Yeah, 100%. Yeah, so we have to proxy for that because we're not a brokerage or a custodian. We don't have the tick data on what it is investors were buying and selling. And so the way we did that is we use the cash flow, I should say the volatility of the cash flows into and out of funds to sort of bucket them. So you would have, some of the funds that had the most volatile cash flows, people, coming and going quite rapidly and with some magnitude. That would be in maybe our most volatile cash flow bucket. And then on the other side, you would have those that are characterized by more stable, steady cash flows. And what you found, to cut to the chase, is that the funds that had the most volatile cash flows, which is proxying for trading activity, that's where you saw the widest gaps. And then by contrast, those that had the most stable cash flows, you saw narrower gaps. And it was like a 3-to-1 margin, the width of the gap between the most volatile, the most heavily traded cohort, and the most stable, the least traded cohort. So that we thought that was an interesting takeaway from the study, something we hadn't done previously.
Right, that is interesting. Is that the largest kind of difference you've seen in all of these different ways that you sliced the data?
I think that's about the largest difference. We might talk about one of the other dimensions that we looked at in a moment, which is volatility. And there's a little bit of correlation between cash flow volatility and then volatility of returns, which is the volatility I'm returning to, standard deviation of returns. You also see, some differences express themselves there as well. But yes, it was one of the more notable and striking findings from the study.
Right. Before we get to the return volatility,
Yeah.
I want to talk a little bit about fees. That's a common theme. I think throughout Morningstar, we find that fees tend to be a predictor of performance.
Yeah.
What do you find in this study when it comes to fee level?
Yeah, so I would say above all, it makes sense to pinch pennies. We absolutely want to do that as fund investors. So if there's one takeaway, even though it's not a focus of our study, it's to do that. In terms of your question and what we found, we did see slightly wider gaps with the most expensive funds and ETFs. By contrast, those that were cheaper, which is where most of the assets are congregating, the gaps tended to be narrower. One thing to keep in mind is that because so much of the assets have flowed to the cheapest funds, you are going to see a certain lumpiness across those cohorts. So the most expensive, they tend not to be home to that many assets to begin with, but you do find that there are wider gaps there. And why might that be? I would say that probably one of the reasons you do see some correlation between volatility of returns and fees. It could be that a manager is charging a higher fee on something that maybe has a little bit more curb appeal to it. It focuses on a narrower part of the market, or maybe there's some sort of unorthodox approach that they take to running the money, and they charge a higher fee for that. Well, we know that investors don't handle those types of strategies as well. So that could be one of the reasons why you see the relationship between fees and gaps that we observed in the study.
Right. So let's return to return volatility.
Yeah.
So how did that translate to investor outcomes?
Yeah, so this has been one of the most striking and I would say persistent findings of the study for all the years that we've been doing it. The hotter a fund is to handle, that is, the more volatile its returns, even when we control for differences in types of funds, the less of that fund's total returns investors capture. They get rattled. And so that can result in, inopportune buying and selling. And so then they end up with wider gaps. So the less volatile a fund was, or an ETF for that matter, was compared to other funds like it, the likelier investors were to capture that fund or ETF's total returns. That is, the smaller the gap tended to be. And again, we have seen that in the study. And I think that's something that certainly it's advisable for investors to pay attention to, or just be aware of the fact that when you've got a fund that rattles around a bit more than others like it, there's going to be a propensity to trade it a little bit more, and that can lead to wider gaps.
Right. So we've already talked about this a fair amount throughout, but you've written that where a fund is utilized can be just as important as the type of fund and how it's used. And so that comes to retirement accounts versus taxable, for example. Can you talk a little bit more about that? Has that been persistent across the different types of segments that you looked at in the data?
Yeah, I would say it's most manifest with allocation funds, which I think we talked about a little bit earlier, which is home to target date funds. And target date funds are so often the default option in retirement plans. I think I probably used the term before, retirement plan is like a gilded cage. You're basically, it's a controlled environment, and it's not really built for you to go in and transact frequently. And I think that probably redounds to investors' benefits in a lot of ways. The less they have done, the better off they have been. I would say that, one of the other sort of features that we would observe, particularly with allocation funds, is they're automated. They mechanize certain mundane tasks like rebalancing, adjusting the asset allocation as time goes on. And so that obviates the need for investors to go in and take certain actions. And one of the things that we know as investors ourselves is that when we go in and do those things, there can be a certain kind of circuitry that we have that just ends up kind of working to our detriment. We just it trips our wires, and maybe we make a choice that we ought not to, buying or selling in inopportune ways. Well, a target date fund, it basically takes that off your hands. And so because it does, we think that's one of the reasons why investors have had more success using those, capturing more of those funds' total returns than they do other types of funds. But context is really, really important. That's been one of the more striking findings from the study.
Yeah, that's really interesting. So to finish up here, what is a takeaway you have from the research that you really want investors to come away with?
Less is more. I think, life intrudes. And so we are going to have to take action to buy, to sell, to determine sort of what our appropriate allocation is going to be, the right funds or ETFs to fill the sleeves of whatever allocation that we've come up with, and then to make changes. Time goes on. I mean, that is a reality. But I think the more that we can automate, the more thoughtful and deliberate we can be about the context in which we place our investments, the better off we're likely to be, because it's going to minimize the number of buys and sells that we have to make. I think it's fair to assume that the more buying and selling that we do as investors, the likelier it is we are to see these gaps form between our dollar-weighted return and the return of our investments. And so really what we should be deliberate about is just trying to find ways to avoid transacting, especially discretionary ad hoc transacting that takes place amid market turbulence. I mean, that's the sort of environment that, really sort of conspires against us as investors and savers. So I would say less is more, automate as much as you can, favor wide diversification. And then I think to a lesser extent, avoid really streaky, narrower sector types of funds, which have proven to be difficult for investors to use successfully.
Right. That's really helpful to think about. Jeff, thanks for taking the time.
Oh, gosh. Thank you. Appreciate it.
That wraps up this week's episode. Thanks for making the show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen, lead multimedia editor Ivana Hampton, and associate multimedia editor Jessica Bevel. I'm Margaret Giles, Senior Content Development Editor at Morningstar. Thanks for tuning in.